The blood in the market continues today with the majority of the S&P down, with only a few stocks that are in fact in the green. And today our focus is on 6 undervalued dividend stocks that nobody is talking about. Now the first one is Mondelez International, and as we can clearly see here, Wall Street have given them a strong buy. We get a buy from Seeking Alpha with a hold from Quant. Now over the last year it is in fact down around 8%. Over the last 10 years, if you have been a shareholder, you would be up around 74%, and it is trading in the mid to lower end of the 52-week range. Bear in mind the fact that cocoa prices had risen over the last few years, similar to Hershey, has meant this company was hit quite hard. However, now it has started to slightly recover. It does have a forward yield of around 2.5% and a forward P sitting at 19.23. Bear in mind the S&P itself does sit around 23. Now in terms of dividend safety, it does have a score of 66, so it does look to be safe, and we can see based on dividend yield theory, currently it is much higher than the 5-year average. And we also note a nice double-digit increase to the dividend just last July, meaning we are anticipating an increase this month. And when we do take a look at the historical rate, 10% last year, 11% over the last 5 years, and over the last 20 years, at a minimum it is slightly higher than the inflationary rate of 4% that we always like to target on the channel. Now, as always, we do get to an intrinsic value of $78 when we run it through the valuation model, and when we do our deeper dives on this channel, we do run through every single one of these models. Today, getting straight to it, with an intrinsic value of $78 and a current price of 66, we always like to start off with that 10% MOS level, and we execute if it meets our 3 criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that today Mondelez is a buy up to $70, then we keep going till it's near the current trading price, and we can see right now in the market it does have a 15% margin of safety. Wall Street, as we said, a strong buy in their eyes, upside of 23%, their price target of $81, not too dissimilar from our intrinsic value as well. As we go through these stocks, do give your thoughts below and let us know if you are looking to add any of these. We then move on to Diageo, where we do get a buy rating from Seeking Alpha, a hold from Wall Street with a sell from Quant. They are trading right there towards their 52-week low, forward P sitting at 17 and a trailing 12-month yield of just over 3%. Now over the last 12 months they are down 27%, and over the last 10 years they are marginally up only 5%. Bear in mind their all-time highs did sit somewhere around $220, and if you want to understand the reason for their decline, well, we did not too long ago do a deep dive on this company. In terms of dividend safety, well, 99, very safe, the highest score obtainable, and in fact it has been one of the highest yields they have offered over the last 5 years, so a severe sign of undervaluation based on dividend yield theory. And their more recent increase was around 5% to their yield, and we can see over the last 5 years and the last 20 years they do tend to increase that dividend pretty much mid-single digits. Now, in terms of the valuation of this company that has taken a hit just over the last few years, our value gets to $147 on a current price of $129. Margin of safety then, at that 10%, we see a buy at 132. At 15%, it isn't quite there yet, so we do see it somewhere between a 10 to 15% MOS, and we can see that Wall Street do believe this as a consideration for the portfolio, upside of 16%, their price target $150, marginally higher than our calculated value. Also, just to let you know, we've released our latest free weekly article running through cheap dividend aristocrat stocks, as well as a quick market update for the last week. We also have other articles here, completely free, instant access by clicking on the pinned comment below. And for those that want to see undervalued dividend kings, well, you also get a free spreadsheet within this article. So the next one we're looking at is Kenview, the spin-off from Johnson & Johnson. It is currently trading right there at its 52-week low, down 27% over the last 12 months, and we get a buy rating from Wall Street, although we note a hold from the other 2 analysts. Yield on a trailing 12-month basis at 4.4% may start to look very attractive, as we do see interest rates getting cut over the next few months, and we also see here the forward P sitting just above 16. Now, they don't have a dividend growth calculation given they've just started to pay a dividend. It wasn't too long ago that the spin-off did occur, but nice to note the dividend does look to be safe with a score of 70, and it is the highest yield they have offered over the last few years. Now with the valuation of Kenview, our intrinsic value comes to $23.23, which does give a nice margin of safety if you believe this company over the longer term. 10%, well, $21, 15% at $20, and at that 20% level, you are pretty much looking towards the current trading price, with Wall Street seeing around 22% upside. So again, this could be one for consideration in the portfolio, but as always, do give us your thoughts below. We then move on to Snap-on Incorporated with a buy from Seeking Alpha and a double hold from the other analysts, trading in the mid to lower end of the 52-week range with a forward yield of 2.75%, a forward P of 14.23, and we can see over the last 12 months they are down more than 8%. Over the last 10 years, if you have been a shareholder, well, you would be up around 117%. Bear in mind, this doesn't include reinvesting those dividends, so you would be up marginally higher. And we can see the all-time high, in fact, is around $300. In terms of the dividend safety, well, again, another 99 very safe score, and we can see marginal undervaluation by looking at dividend yield theory. Nice company in terms of dividend growth, well, 15% just last November, 15% on average over the last 5 years, and nice double digit over the last 20, definitely giving this one a dividend growth title. Then when we look at the valuation, well, our intrinsic value at $319 is higher than Wall Street. They believe the share price, in fact, over the next 12 months will hit $298 with upside of 10%. So our 10% MOS level, in fact, would be around $287 at 15%, pretty much again on this current trading price. So Snap-on 15% MOS and 10% upside per Wall Street and their own target. We then move on to ConocoPhillips COP with a double buy rating and a hold from Quant, trading in the mid to lower end of the 52-week range, forward yield of 2.7%, 0.4. Over the last 12 months, well, up 7%. Over the last 10 years, as we can see, up 42%. But remember, this is based on you have bought the shares around 10 years ago. For example, if you had bought right at the drop at $25 in 2020, then you would be up significantly more. In terms of dividend safety, well, 61 safe score. And we also note that the current yield on offer is pretty much in line with the 5-year average. Similar to other companies, very nice growth over the last few years. 14% in November, 32% on average over the last 5 years, and 9% over the last 20. In terms of the intrinsic value, well, our price at $139 is marginally lower than Wall Street. They see 27% upside, $146 price target. So a 10% MOS would be a buy at $125, 15% at $118, not quite at the 20% level yet, sitting somewhere between a 15 to 20% MOS, with Wall Street, as we said, very bullish on this stock. We then move to JBHT, Hunt Transport Service, where we actually get a buy from Wall Street, a hold from Seeking Alpha, and a sell from Quant. Quite the mix there. In terms of forward yield, well, just above 1%. Forward P just above 28, and again trading right there towards its 52-week lows. Down 13% over the last year, and over the last 10 years, if you have been a shareholder, you would be up 107%, but we can see all-time highs sitting around the $220 mark, in fact, in 2024. When we talk about the dividend safety, well, nice to note, a very safe 89 score, undervaluation on dividend yield theory, and when we come to the dividend growth, pretty mediocre increase this year because that is below the inflation target that we have here of 4%, but over the last 5 and the last 10 years, they have historically increased that dividend by double digits. Then when we come to the intrinsic value of just under $200, again, not dissimilar from Wall Street, they have a price target of $195. They see upside of 20%, and with the current value of $163, a 10% margin of safety would indicate a buy at $180, at 15% around $170, and in today's episode, not far off 20%, but sitting right now 15 to 20. As always, do give us your thoughts below on these 6 undervalued stocks, whether any of these have caught your attention, or maybe they're not ones that you do want to put into your portfolio. As always, if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.